Hello and welcome to DigFin VOX, Voices in Digital Finance. I'm your host, James DiBiasio. Before we get into today's interview, please like this episode, subscribe to the channel. These things help bring other people to the show. My guest today is Michael Shaulov. Michael got his start in cybersecurity in the Israeli military. He took that into the commercial world, founded a company, sold it to Check Point, a pioneer in that space, before founding Fireblocks in New York. Fireblocks likens itself to being the Swift of cryptocurrency. It is a provider of plumbing and infrastructure. It has just come off a $133 million Series C funding round, which includes some pretty big heavy hitters writing checks. We spoke about the proceeds, we talked about the partnerships. That cybersecurity background of his is definitely coming into play because cyber attacks remain a huge threat. And we talked about the race between trying to make cyber security safe for crypto. Lastly, we looked at some of the emerging projects, the stuff he's doing with Diem, some of the other really cool stuff going on in this space, and what are the issues around how green can Bitcoin be. But for now, sit back and listen to this conversation with Michael Shaulov. Michael, $133 million C raise round. That's big by any standard. So congratulations on the raise. What are you going to do with the money?
Yeah, thanks. I appreciate it. So clearly the space is now, the space that we are playing in is expanding in a very fast pace, actually much faster than what we've expected. So just to give people some sort of idea, in the last quarter, actually, we just sort of crunched the numbers. This quarter, we sort of onboarding 106 new customers, right, to Fireblocks. This is pretty much the same amount of customers that we onboarded last year in 2020. It took us 11 months to basically get to the same amount.
And what kind of customers are we talking about?
So that basically includes anything from small crypto hedge funds to some of the biggest exchanges, all the market makers, neobanks and fintech companies, and eventually also banks like, for example, Bonnie and other banks that we are working with. So really, pretty much, from the biggest players in the market, or maybe like incumbents that are basically coming into this space, to the most agile fintech companies or startups that are essentially specifically targeting and setting up their operations in the cryptocurrency space.
Okay, so let's go back to, you've got this massive growth on, you've raised a lot of money, and what do you need it for?
So there are a couple of things. First and foremost, we have a strong investment in technology and product. The fact that this is a very fast-paced industry, you continuously need to innovate, you continuously need to push on the development that we are doing. So, if a year ago people were expecting us to support specific protocols and doing staking, mid-year people expected us to support 4 different variants of connectivity into DeFi. And clearly now we have a lot of things to do around, NFT, tokenized securities, a lot of, there are new innovation. There is not new innovation all the time. And we're planning to basically double the engineering team. On the other side of the spectrum, clearly there are a lot of customers that need our help in getting set up with infrastructure. So we need the account management coverage, right? So basically salespeople that are able to interact and manage the customers and equip them with the technology. And we're also very well known for our support and customer operations, right? So we already actually doubled the team over there this quarter, and we will need to double it in the next quarter as well. So there is basically a pretty massive allocation of capital into I would say pre-allocating resources to something that we do view as a substantial growth. That's part of the usage of the capital. The other part is actually more, I would say, let's call it making sure that we are a long-term player for our clients. I think there are two things that our clients want to guarantee. Well, maybe we'll start with the obvious. Clearly, an infrastructure player that is sort of in the plumbing of the services that our customers are running is expected to provide a very resilient type of service, and resiliency also means that they don't expect to re-platform to a different provider over a short period of time. So the financial stability of the firm is important for them, and that financial stability means that we have enough capital to sustain, even fairly long, potentially downturns in the market, right? As we call them, crypto winters, which just generally, I think, part of this market. So hopefully it's not going to happen again. Hopefully everything from here going to be a smooth ride up and to the right? But we also need to prepare ourselves for something that is unexpected. And the other aspect of it is really independence, right? So recently, I think there is, with a lot of incumbents, with big pockets coming into this space, we're starting to see some consolidation in between the smaller players. Clearly, the number of incumbents exceeds the number of just infrastructure providers out there, just in general. Right, so I think everyone needs to basically take a decision, if they want to partner, if they want to build, or if they want to buy. But what we want to make sure that to guarantee to people that they want to partner and they want to select who is the best partner, that they know that they can partner with us, and we will be there, this year, next year, in 3 years, in 5 years, and we're not going to basically be consolidated into their competitor.
Yeah. You've also brought on board some institutions as shareholders in this round: Bank of New York Mellon, Silicon Valley Bank. What is the nature of these relationships, and why do you want to work with these particular institutions? What's the value that they're going to bring to you besides just writing a check?
Well, they're clients. Let's start with the obvious. So I think that part of the deal of them becoming a client, and I think that relying on our infrastructure, is extremely strategic for them, right? In some ways, if you're a bank or if you're a custodial bank, and you view digital assets as your future, right? Fireblocks becomes your core banking system. Fireblocks becomes basically the infrastructure that the future of your business relies on, right? I think that they are not big shareholders. They're actually fairly small shareholders in our company. And I think that there are both, symbolic and true aspects around, a partnership and alignment of interest that they know that they can grow with us. We know that we can grow with them. And, this market is actually going to grow we think that this market is going to grow substantially. So the alignment of interest is important. And for them, it's important to be even if small shareholders, still some shareholders and part of our success.
Yeah. Okay. I don't know if it's you or if I read it somewhere, but Fireblocks has been likened to sort of the Swift for crypto. I don't know if what's the biggest difference between you and Swift in the traditional world?
So first of all, it's the underlying technology, right? I mean, in some ways, the way that assets are being, okay, let's start from the beginning. I think that the biggest difference between blockchain and the traditional world is how assets clear, right? Where in the traditional world, we have this basically double booking system, and eventually there is sort of an offset of the balances that eventually will propagate through the, one bank to a completely different bank, right? Through that system. In blockchain, there is an instantaneous peer-to-peer transfer on this decentralized ledger, right? The way that Swift works, as we all know, is sort of propagation of those messages that is highly applicable for negotiating or basically coordinating those value transfers in the old world, where if you send money from Singapore to a bank in the United States, you might have like 10 intermediary banks that eventually will offset those balances. It will take those, international transfers take 24 to 3 days to clear, right? Usually if the money is not lost somewhere in the middle, and then people need to figure out in which intermediary bank it is stuck. On blockchain, it's instantaneous, right? And it's peer-to-peer. You don't have all those intermediaries, and that just requires a very different technology, and also a technology that solves a completely different set of problems, right? So first of all, some of the issues that exist with blockchain that don't exist in the old world. The first one is that blockchain is open, like the public blockchains are open, right? Which means that there is no context of identity clear, there is no context of institutional identity. That's the first thing that we bring into that equation. The
second, so Fireblocks provides some of that comfort level around identity and verification so that licensed institutions can do business.
Right. And the second thing is that because of the instantaneous settlement, if you basically look at Swift, you have a reasonable amount of time for recourse. And generally speaking, the assets over there can be recourse, to the point that if we take an example of probably the most catastrophic thing that ever happened to Swift, was the breach in 2017 or 16, where the North Koreans essentially hacked multiple terminals and eventually tried to redirect over $1 billion of assets. Eventually, they were able to only get $80 million out, mostly because it took time. There were recourse mechanisms, and eventually analysts had the opportunity to basically withhold those transactions before they actually reached their final destination, and were shuffled outside of the banking system.
Right. This is the one where the Federal Reserve in New York spotted some errors in the typing from the Bank of Bangladesh, I think. Is that the case you're referring to?
Yeah, there were like a couple of those, but it was I think initially it was actually, I think in Germany, the analyst in Deutsche Bank, but we're talking about the same incident. The main incident was basically eventually the bank that was most affected was the Bangladesh bank. Yeah. In blockchain, what we've seen, a lot of the attacks that are actually happening are attacks from a similar nature, where basically there is a redirection of the transfer. The only issue is that with blockchain, because it's an open ecosystem, it's peer-to-peer, it's instantaneous, the assets are gone immediately, right? So if someone would have redirected $1 billion of transfer, it's gone, right? Fireblocks basically solves this issue, and it's not only an issue of identity, which is important, and by the way, in some ways we do use even the formatting identification that is compatible with the ISO 22001. But the main issue over there is that the technology that is required to really protect those transfers is extremely different. Our technology is really built to protect the real-time, the non-recursive nature, and it's not a technology that was invented in the 70s. It's a technology that is relying on the newest improvements and the newest innovation in cloud security, in cryptography, and they're being utilized to basically create a security around those transfers. Which,
where are you seeing the security threats coming from when it comes to blockchain and peer-to-peer transfers of value? Is it inside jobs? Is it state actors? Is it a kid in the basement somewhere? What's the threat spectrum?
Yeah, so unfortunately, all the above, and that's actually the reality. Actually, in 2018, I remember that I was talking with a cybersecurity focused VC, and I told them, in the next couple of years, you see that the only thing that the cyber criminals will be focused on is cryptocurrency. The reason for that is that the future of money, it's the internet of money, right? And arguably, there is no reason for anyone to basically go after any other target, right? Because it already has value. So in practice, you actually see any threat actor, which is like, from the kid in the basement, from the script kiddie, as we call them, to the nation states, and a lot of it is actually insider, right? So there is actually statistics from, I think, Verizon data breach report that shows that 50% of the attacks actually had an insider involved, right? It's just general statistic in the industry, not really specific to crypto, but in crypto, what we're seeing is actually almost the same thing. Nation actors are fairly active. Most of the nation state actors that you actually see active over there is really North Korea and sort of regimes that they have economic sanctions, and basically cryptocurrency, hacking cryptocurrency, or basically obtaining those assets is actually able is a mean for them to add to their balance sheet. Okay, just like very there are pure nation level economic reasons to do that, and clearly they are able to deploy very sophisticated resources into those attacks.
Yeah. How do they wash the tokens or the coins? I mean, if you can trace what's been stolen, so theoretically it'd be very hard to then put those back into the marketplace.
Yeah, so I think that unfortunately the tracking tools are not yet as deployed as we wish, right? So in theory, if everyone had, every wallet, every venue had a chain analysis integrated in, and by the way, DeFi is also to a certain level part of the opportunity for them, because right now there is no in the DeFi protocols, they actually don't have any mechanism right now to
KYC.
To KYC or to identify the source of those transactions. But overall, even I think there is a lot of emphasis on DeFi on those things, which part of it is actually going through there. But unfortunately, those tools are not yet widely deployed across all the different players that serve as the laundering point. And furthermore, there is still a significant delay in terms of the speed to report. Okay, so even going outside of the level of nation state actor, we've seen, we helped investigate quite a few of the it's not script kiddies, they are more sophisticated and more more organized crime, I would say. But by the time that we are able to propagate the information, it's sometimes too late, right? It's unfortunately a bit of a maturity issue of our ecosystem. And to be honest, everybody are very cooperative. You'll call any big exchange and tell them, hey, this wallet, here's an indication that this wallet was used for hacking. And I've done some of those calls myself for people that approached us. They're very responsive, right? But the protocols and the time that it takes to basically coordinate all that, because of the instantaneous nature of those settlements, sometimes it's just too late.
Right. Okay. One last question on this topic is, I guess we're sort of in a race. On the one hand, we're talking about the mainstreaming of crypto, the entrance of central bank digital currencies. You mentioned NFTs, stable coins, the lot, and at the same time, rising interest from attackers and bad actors. If I have some crypto on my phone and I want to either invest it or use it in some way, how worried do I need to be that that this race is not going to be won by the right people?
It's just general question around cybersecurity. So cybersecurity, I spent 20 years in that race, and unfortunately, it's just a race, right? It's basically a mouse and cat game, and I don't think and it wasn't, by the way, different in the traditional banking space. I think people are very focused on the losses or the hacks that we're seeing in the crypto space, the hacks and the amount of money that is stolen currently in the traditional financial system is order of magnitudes of what we're actually seeing here. So just to give some perspective, in 2000, I think 19 or 20, the amount of assets that were lost from corporations where there was what we call business email compromise. So basically someone phished the CFO and asked the CFO, hey, I'm the CEO, you need to do this transaction immediately. It's about, $4 billion, right? It's not small amounts. The FBI is actually publishing an annual report on those compromises. When online banking started back in sort of 2005 to 2012, there was the organized groups in out of Eastern Europe on an annual basis. They were able to compromise $100 million, right, from those online bank accounts. Eventually, as a cybersecurity, as an industry, we were able to solve and basically mitigate a lot of those attacks. They continue shifting. I think this is sort of also what excites me in my profession. I wake up and I will wake up tomorrow, and what was relevant today is no longer relevant tomorrow, because we are dealing with people on the other side that are innovative and sophisticated as us. So I don't think they're going to win. I think that we are going to win, but I also think that it will require significant investments. I also think that, by the way, there is a big opportunity specifically with this technology, if things will actually work the way that they're supposed to work, if the investments will be there, I think that we'll actually bring this to a much more resilient state than the traditional banking system, because inherently, because we are dealing with cryptographic elements and the underlying blockchain is very secure, right? The Bitcoin blockchain, the Ethereum blockchain are designed with the security and the resiliency components. As long as if we are able to properly invest in the perimeter, we will be able to bring this into a much more secure state. Now, to your question about if you have a wallet on your mobile phone, at the end of the day, it's sort of a game of ROI, right? If you have, $200 or $5,000 on your phone, and you're using a proper wallet, using a secure wallet, you're using an iPhone that is not jailbroken, or using an Android device that is actually fairly patched, I don't think that there is an issue. I think that you're actually fairly secure, potentially more secure than with your, bank account. If you will hold $1 billion or $500 million on your phone, I think that this is unwise, because basically to buy an exploit to a fully patched iPhone on the dark web will cost someone $3 million, right? So there is a very clear arbitrage of buying an exploit for $3 million, and then being able to obtain $500 million. I think it's no-brainer for people that know how to do it and where to obtain it.
Okay, well, I'm in the media business, so I don't ever have to worry about having $1 million worth of anything on my wallet. But for those who might take some tips from Michael Shaulov, you have a recent announcement with First Group regarding onboarding Diem, the stable coin that we're all expecting to come out of the Diem Association, which is backed by Facebook, among others. Tell us a little bit about how this came to be, and what you think is the vision for stablecoins like Diem and perhaps other corporate coins.
Yeah. So we were sort of involved in the peripherals of the Diem or Libra project, just like tracking and being fairly close to the association from the early days. I'm a big believer actually in their project, so personally, because I think that at the end of the day, Facebook and the players in the association, they have enough user base and also a track record of pretty slick user experience of bringing things to the masses, right? They have the expertise. Some of the people that are working on the wallet, the experience that will be that in terms of how this will be exposed to the users are some of the brightest minds in technology and consumer consumer internet. Our play there with first is that eventually those new forms of stable coins, and specifically Diem, is actually designed for commerce, right? So in my view, it's sort of designed, it's designed, to replace the dollars and to replace the credit cards, right? And there is a good argument of why to replace the dollars, because I cannot send those dollars over the internet, and there is a good argument of why to replace the credit cards, because we're paying 3% transaction fees on every payment, and it takes 48 hours to clear on the other side. What we basically built is an infrastructure for merchants to, whether those are online merchants or in-store also, to be able to leverage an infrastructure, basically create merchant-grade wallets where they can receive those payments and eventually do treasury management for their business with Diem that they are obtaining. So, you arguably in day one, they probably are not going to pay salaries for employees. So the ability to basically off-ramp that to the FX currency that they need to pay the salaries and do the treasury. And hopefully down the road, when this will be something that those stable coins will be something that people will be keen to maintain as a treasury position. We will be able to add functionalities in the form of interest accounts and things like that. Right now, to your question about corporate stablecoins like USDC and some of the other stablecoins that are currently coming out, I think that our view over there is that it's a very powerful tool for B2B commerce or B2B transactions. Personally, at Fireblocks, we actually, I think, collect probably 30% right now, 25% of our invoicing, and basically the collection on our invoicing is done through stablecoins. So we don't actually accept sort of volatile cryptocurrencies. We only accept wire, ACH, credit cards, but our preferred method of collection became USDC and some of the other stable coins because of the cost, the efficiency, the programmability, and eventually also access to pretty sophisticated interest mechanisms through DeFi like Compound or Avi.
What do you think will be, out of all of these different emerging areas of the crypto universe, I guess the biggest growth area for you this year? What are you most excited about out of all of these things?
There are sort of 2 to 3 areas that we are very excited about. The first one is just generally speaking, crypto, predominantly Bitcoin, because we have a lot of those incumbents that are coming in. And the first thing that they want to do is to basically allow their clients to buy and sell Bitcoin. The area that I think is actually going to be a real breakthrough and where we're going to see a lot of innovation for us is stablecoins, and specifically the cross-section between stablecoins and DeFi, right? So we are working on quite a few interesting things on the DeFi space with some of the DeFi protocols that they will directly impact the utilization of stablecoins in an institutional way. So we're both working hard with some of the banks and some of the incumbents on basically bringing more corporate stablecoins to the market, or basically commercial stablecoins, commercial money-based stablecoins to the market, and in parallel, basically investing in DeFi protocols that will create very interesting things that people can do with them. With regard to NFT, I think right now there is a lot of momentum about it in the consumer space. There is a lot of discussion in the institutional space as well. I don't know if you will see the critical mass there in 2021, maybe towards the end of the year.
Okay. Last question is, how does the industry deal with some of the environmental issues around proof of work based protocols like Bitcoin? What are the solutions that can be, you're an infrastructure plumbing person. What are some of the ways that infrastructure can perhaps mitigate the worst effects on the environment of all the electricity consumed by digital assets?
Yeah, so to be honest, I'm actually a very environmental person. So this aspect is actually something that I do think a lot about. And first and foremost, it's sort of not very clear where we are at the moment, because it's probably somewhere between 40% to 70% of the mining is being done through renewable sources. I actually asked one of our sales ladies that is very plugged into the Chinese mining ecosystem, what she thinks the numbers are. She thinks that it's about 40%. So probably we are not in the worst case scenarios. People describe that this consumes the same amount of energy as Chile, but we are also not in a really good place, right? It's still fairly concerning numbers. The next thing that I think is now happening is basically twofold. One, there are basically the proof of stake protocols that are becoming more and more mature. I think we all hope that ETH2 will come sooner than where it is, but I think that other protocols like Cardano, for example, right, is basically picking up. And if we will not see, I think that basically outside of Bitcoin, all the other protocols will need to go into some form of proof of stake, or something which is not as wasteful from an energy standpoint as the proof of work. Probably not going to happen tomorrow morning, but the brightest minds are working on that, and hopefully we'll see it happening in the next 24 months. The second aspect is basically optimization of proof of work, where there are a lot of startups that are doing very interesting things over there, right? So there are startups that are figuring out how to use excessive energy that is anyway being wasted. I've seen probably 3 or 4 different startups that are doing that. And hopefully we'll see also some form of regulation. So we've seen that in China, in Mongolia, I think recently, basically, where they banned some of the activities over there and tell them, well, you're not allowed to basically use that kind of energy to do what you're doing. So I think that if there is an area where the regulators should probably step in, is around dictating renewable energy standards around this kind of activity, which I think the combination of the two should probably get us into a state that we will all feel much comfortable about the future of this market.
Great. Michael Shaulov, it's been a pleasure having you on the show. Thank you very much, and good luck with your next steps.
Thank you so much.